No,
Would
not
Adam
at all.
buy Tesla?
No,
Like
no.
$40 you also won't buy, or $30?
No, I'm not interested.
Oh.
We are clowns thinking that we can break the economy.
Welcome back to episode 10 of the Backholder Pod. So today we have a really special guest. So I think it's also timely enough because it's the end of the year. So at the time of this recording, or when we're going to upload this video, it's going to mark the end of 2022. So we're going to mark the end of the year with a big bang. So we have the man, the myth, the legend, Adam Khoo. So welcome Adam Khoo onto the podcast itself, and very happy to have you on the podcast, and it's our honor. How have you been, Adam?
I've been good. Always good. It's great to be here.
Always good. Okay, I know the market hasn't been very kind in 2022. So we always look forward to your videos as well as some sort of inspiration and really seek some sort of solace. So yeah, as always, remember to help smash that like button so that the YouTube gods will bless our channel and we can invite more and more guests to gain so many insightful comments and ideas about investing in the stock market again. So I think Eric actually has a pretty interesting question for Adam.
Sure, yeah.
Okay. So my question has to do with your early ventures in business. Because I was looking at your wiki page, right? Like before you come, I have to know who you are, right? Like do a bit of CSI. So I saw that you actually in your secondary school, you already started a mobile disco business. I don't know if that is like accurate.
Absolutely.
Or true. Absolutely.
In fact, yeah, if you want later, I can send you. I still have the name card that I created for my mobile disco business. This is one of my very precious mementos, right? Yes, I started the business at 15.
Wow.
Yeah, it was a mobile disco business. But in those days, it was very common because there was no internet. You can't start an online business. So a lot of, I wouldn't say a lot, but many teenagers started mobile discos. It was the in thing at the time. But I started relatively early, I actually started as a DJ because I was thinking of all kinds of ways of making money. And I love music. The trouble is I can't sing. If I sing, all of you will run away and you lose all your respect for me forever. And I can't play any musical instrument. So the closest I can get is to DJ, right? So I really learned DJing myself. And then I started DJing part-time for entertainment companies at that time, earning extra money. So when I DJed for these companies, then I began to learn the whole business, how they ran the business, how they use the smoke machines and the disco lights and how much they charge and all that. And so when I made enough money, which was about $2,000 at the time, I bought my first set of mobile disco equipment, which was a big console with the 2 turntables and the 2 helicopter lights. Yeah, so that's how it started, that first business.
Okay, so my question, right, like it's not so much like how you actually do the business. My question, right, when I first read it, I was thinking back, 15 years old, what was I doing? I was in the school canteen playing magic cards. So the thought about starting a business never ever crossed my mind, like maybe until I was like 30 plus. So I'm just very curious, what made you start so young? Who gave you the inspiration? Like, is it your background? Like, does it have to do with your family? Like, there are whole family business kind of thing that influence you?
Yeah, I guess. So I've actually wrote this in one of my first books that so I come from, I'm not ashamed to say a wealthy family, right? So all my uncles are multi-millionaires. They're all worth millions and millions of dollars, right? My dad was very wealthy as well, but he was not the wealthiest, right? But his brothers were even wealthier. So I grew up in a family where living in a bungalow with a swimming pool is normal. It is a normal thing. Making a few million a year is normal. Okay, so I came from that thing. Unlike most people say, I came from poor background. I have to say I did not come from poor background. But the funny thing was, or the good thing was that my father, and he's very proud when I say this, so I'm okay to say that and he hears this, right? My father is one of the most stingy people in the whole world, okay? Especially to me. Yeah. And since I was a kid, my father always gave me less money than any of my other friends who are not rich. Okay. And he would not give me any extra money. So, I mean, when I was young, I loved Star Wars toys. I love Mars, and you guys will know, you're too young. Anyway, so every time I ask my dad, hey, I want to buy, this Star Wars toys. You want to? Buy yourself. Right? Or in those days, I love to buy CDs. I love music, right? And I say, Pa, can I have money to buy music? Buy yourself. So in a way, I was very frustrated because I knew he was rich. I knew he had a lot of money, but he won't share anything with me. I thought he was a real stingy bugger at that time, right? So I was really upset. I said, okay, fine. You know what? I make myself. So because of that, I was always very driven to make money, because I always said that I want all these things. No one will get, I want to make money, right? And so that is why I was a money-hungry kid. That in class when the teacher was teaching, I mean, you guys know my early story that I didn't really do well in school, because in class when the teacher was teaching, I was behind thinking how to make money. Yeah, so I was a naughty kid. I did all kinds of crazy stuff to make money, right?
Right. I think on this topic of making money, right? So investing immediately comes into mind. So investing is actually one of the greatest tools that many people employ. So maybe I just wanted to throw out this discussion about dollar cost averaging versus timing the market, right? Because recently there's this very contentious point on Twitter. Somebody basically commented that everybody that backholded and continued dollar cost averaging got poorer this year. But I think before I get Adam to comment on this, right, I just wanted to hear Bunti's perspective on this idea on dollar cost averaging versus timing the market. And since I know you are holding a portfolio now, so you got poorer this year, do you have any comments to that particular tweet itself?
Yeah, so just for Adam's background, right? I think this tweet, when I saw it, I got a bit angry. And I don't usually get angry when looking at tweets. To me, it's all just entertainment. But this one is like, because I see myself as a long-term investor, I don't do trading, I don't know TA, I just buy and hold. I think this is my way of getting, be successful in my retirement now. So basically just buying good companies. When I saw these tweets, I think why I got angry is also because there's truth in it. In the sense of, if you really just buy and hold, you hold for the past 1 year, you really get poorer. So it stuck me because, okay, I got painful because my portfolio also down. And it seems that doing some form of TA looks like, hey, okay, can at least avoid some losses. So I think that's why I just want to hear your thoughts on this. Like, do you think, let's say, taking the trading part out of the picture, just for someone who is like, okay, I just want to do a DCA, I just want to build my portfolio, and I just do this now, and it seems like I'm wrong now. So let's say someone having this kind of thinking, what will you tell the person?
Let me share with you my own personal experience. Okay. When I first started, I was a pure market timer. I was more of a trader than an investor when I first started. Okay. And initially, I used to do a lot of market timing, where uptrend, I go long. Then once reverse downtrend, I get rid of everything and I go short. And then later bottom, I buy back again. I used to do that last time. And I made a lot of money doing that in 08, 09. Because at the time, if you look at the market, in October 07, the financial crisis started, right? And the uptrend reversed into a downtrend very smoothly. And that downtrend lasted for about 1.5 years. And then from there, it bottomed and reversed back into an uptrend. So during that time, using market timing techniques, like I use moving averages, right? So when moving averages start to slope down, cross over, when I see lower highs, lower lows, I go short. At that time, it worked really well. And I made a lot of money from it. And that's why I wrote that book, Profit from the Panic. In fact, I made my first big fortune during that time. Market timing, right? Then what happened was that in 2011, I don't know whether you guys remember 2011, right? The market went down, but shot up very fast. Okay. That was during when the US government debt was downgraded by S&P. All right. So if that time you did market timing, you got effed by the market. Because the moment it went down, if you sold and shorted, it went up so fast. If you had to buy it back, you buy back much higher price. So you really got screwed if you did market timing, which I actually got screwed. Or I was like, okay. So that was 2011. Then 2016 was the Brexit come China crash. Same thing happened. Market went into a downtrend. If you sold or shorted, you also cannot whack because the burger came up again. Okay. Then 2018 was the taper tantrum. That was when the Fed wanted to do a bit of stop QE, right? Same thing. Market went down. If you attempted to market time, you also got killed. you would have ended up selling at the bottom and then have to buy back at the top or never buy back at all. And then if you never buy back all, you have missed a big run all the way to 2020, right? So that's when I learned this lesson that, see, whatever strategy you use works sometimes, but never works all the time, okay? Whatever strategy you use, there'll be periods where it works damn well, but there'll be period it doesn't work. No strategy works in all periods. So the question is, which strategy will outperform in the long run? So, for example, if you do market timing, yes, in periods like 08, 09 works damn well. 2011 doesn't work. 2016 doesn't work. 2018 doesn't work, right? But in the long run, if you keep doing that, will you make money? Yes, you will. But you won't make that much. Because getting whipsawed in 2011, 2016, 2018 would end up you losing everything that you made in 2008, 2009. Or maybe not lose everything, but lose a lot of it. Okay? Same thing with buy and hold technique. So buy and hold technique works sometimes. But there are times it may seem like it's not working. Like this year, if you buy and hold, you may look like an idiot because you're right? Same thing like 2008, 2009. If you held during that period, go down for 1.5 years, look like idiot, right? But buying and holding worked in 2011. It worked in 2016. It worked in 2018. It worked in 2020. Okay? Now, so if you did the buy and hold throughout the entire period, from the beginning of time, would you have made money? Yes, you would. So every method makes money if you are consistent, if you stick to that method and don't go and jump from one method to the other method, right? You got to stick to the method. So the question is, if you take a long-term period, let's say you take 30 years, which is market timing versus buy and hold, which one makes more money, right? So I actually did all this back testing already, right? The answer is about the same. At the end of the day, it's actually about the same. It's about the same. Okay. So because of that, nowadays in my core portfolio, I don't bother to market time anymore because I realize that at the end of the day, you get about the same result. But with the market timing, there's a big danger that if you mistime it, that you don't get out in time or don't get in back in time, you could severely underperform at the end of the day. So for the great majority of people, it's better to just buy and hold. Okay? Because even if you market time, yes, there'll be periods you look like a genius, but in the long run, you actually know better off. And I say this from both my personal experience going through that myself, and number two, through back testing from other periods.
Yeah.
Let me add on something. There's a very interesting article. I don't know whether you guys have read this article. I forward it to you. I can't remember who wrote it, but the title is "Even God Can't Beat Dollar Cost Averaging." Have you guys read this?
Sounds familiar.
Yeah.
Yes.
Yeah, it's a very interesting article.
The comparison.
So it's based on 40 years of back testing data, right? So they found that if you were God, you can buy at the bottom of every crash. Okay, so this guy calculated, right, that if you have a crash of at least, 15-20%, and you were able to buy at the bottom every 40 years, versus if you just DCA, at the end of 40 years, the DCA beat the market timing that you're buying at the bottom. Why? You may say, why? It doesn't make sense, or you buy at bottom should make more, right? The reason is because there are long periods of time where the market just keeps going up. Yeah. And if you're waiting for that perfect crash to buy, you're out of the market for 5-6 years sometimes. And if you just stayed in, you would have made more just staying there.
Yeah. So my question is more like, if we look at the data, 40 years data, of course, we can arrive at the same conclusion. But all this talking about like, let's say 1 year ago, there's all this narrative that really sound convincing, For example, people say from 2010 to 2020, it's all about the QE. QE push the market up. Now, no more QE, we have QT, and then the short rate going up so much. So the Fed want to tank the market. So all this story, it sounds so convincing that shouldn't we let's say if I don't short, should I just sell my entire portfolio, stay on the sideline until the uptrend is back, then only reinvest it? Basically, market timing.
So you see, right, before 2022, yes, there were a lot of people who say 2022 will crash, right? And they give all kinds of reasons why you'll crash, correct? And now you say, oh, they were right. They were so smart, right? But these same burgers were saying the same thing for the last 20 years. If you look at the last 20 years, every year, there'll be the same group of clowns, or maybe a different group, whatever, that say the market will crash the next year. And they all have this certain arguments for that year. So you never know when that year will happen, because remember, a broken clock is right twice a day. Okay? So now you may say, oh, I should have listened to them. But if you had listened to these people, you would not have been in the market for the last 15 years. I can tell you that. In fact, if you guys recall, after 08, the 08 crash, during the recovery in 09, right? In 2010, a lot of people say market's going to crash. And they gave all very valid reasons. 2011, they said market going to crash. 2012, they said market. So if you listen, you would not have been in the market for the last 20 years. Okay? Now, but if you had ignored all these people, which I do, right? If you ignore all these people, and you're in the market for the last 20 years, would you have made a lot of money? Okay, don't say 20 years, just say 10 years. Would you have made a lot of money in the market in the last 10 years? Yes or no? Yes, right? So even with this year's drop, would you still be up? Yes, you still be way up over the last 10 years. And you're better off than all these clowns who maybe never even got in.
I think Adam has a term, right? I watched one of your videos. You call it doomsday porn. Just basically people feeding
These
on
are the
negativity.
doomsday porn stars like Robert Kiyosaki, who sucked, you know?
Right.
I mean, I used to respect the guy when I was young because I read his book. I thought it was a great book. Then he went a bit nuts, talking about, I don't know, whatever, right?
I know that your views are right. Personally, I also believe in dollar cost average. But this whole year, I was
it's not about my views. It's about facts.
Yeah, it's about facts.
Right? It's not an opinion, it's a fact. Right? So it's very important that you separate facts from opinions, right? So for me, I always say, when I make a statement, it must be backed up by data, right? Back testing, hard facts.
But maybe I could challenge it by saying what if you have you have known a lot more data? Because whether the market goes up or down, it always there's a whole equation behind it. Like maybe 2022 was down because it was a combination of high PE ratio, of interest rate, of inflation. So when you add up, and also the institutional investors are pulling out. So if you have access to all this data, wouldn't it make sense to wouldn't it be easier to tell if the market is going to go down?
No, I tell you why. Because there were many instances in the past where the PE ratios began the year even higher, and the market went up double digits in the next 5 years. Okay, so people always like to think that there's a magic, there must be a formula. People always like to think that there must be a formula to predict that, right? And I mean, don't listen to me, listen to Peter Lynch and Warren Buffett, who have been in the markets for longer than you and I have been born, okay? And think about it, after all the years in the markets, what do these two guys say? Or even Charlie Munger, they keep saying what? No one can predict the market. They keep saying that, but people don't buy it. Why? Because people like to think that. That's why people still go to fortune tellers.
They think they're better.
Although you know it's illogical, but people still go to fortune tellers. People still want to know the future because it's a human need to want control. And it's this human need that wants control that makes us seek out holy grails. And as long as you're in this mindset, you will forever be in the matrix. You'll forever be stuck in this matrix. So you got to free your mind from the matrix. Trust me, if there's a holy grail, I would have found it. Right? And Buffett had this famous saying that the only value of stock forecasters is to make fortune tellers look good. And like what Peter Lynch said, if the head of the Federal Reserve can't predict long-term interest rates, if he can't, you think you can? Right? You guys study econs in school? Yep. Right? You guys know who's John Keynes, right? John Maynard Keynes, the father of economics. We all studied John Keynes, right? And I don't know whether you guys have read this or listened to this. This was a story that was shared by Warren Buffett, right? That when John Keynes started investing in the markets, he attempted to invest based on his knowledge of economics. So he used like GDP, inflation, credit cycle, and attempted to invest using his style, his knowledge, right? And he went bankrupt 3 times doing that. Until eventually, he started to invest more of the Buffett style, which is ignore the macroeconomics. Don't think you can predict the economy. Ignore the macro. Focus on the business. Just buy good companies that are undervalued. Sit on it. And when he did that, he started doing really well. And this is the father of economics, right? So if the father of economics can't predict the economy, come on, who you think you are? we are clowns thinking that we can predict the economy. So I tell you, so the thing is, but my students say, but Adam, then why do you talk about macroeconomics so much? And I say, I do it purely for entertainment. Right? But my decision to invest in a company has nothing to do with all these economic predictions. Whether I think the economy is going to crash next year or go up next year, I still buy. If it's a good company, if it's undervalued, I still buy. Right? But let me make a comment about what I think Chee King said when we first started. Chee King said it's been a very tough year. Did you say that?
I think I used the word tumultuous, but yeah.
No, I think you said tough, right? Or whatever it is.
Right.
Now, I think what's important now, because I've got a background in psychology and NLP and all that. So I tend to always remember that nothing in life is good or bad. It's your perception. So why do you say it's a bad year? Why do you say it's a good year? It depends on your objectives, right? So let me give you an example, right? If your objective is to build your wealth, is to build generational wealth. If your objective is to be financially free in 5 or 10 years, is 2022 a good year or bad year? Think about it. To me, I think it's a damn good year. If you are someone who's investing for your future, because it's giving you the chance of buying great businesses and massive discounts. That doesn't happen that often. Now, think of the reverse, okay? I want you guys to imagine this. Now, by the way, coming into 2022, was the market cheap or expensive? What do you guys think? When we started 2022, was it cheap or expensive?
The high side?
Yeah, it was high, right? It was not cheap, right? It was relatively fairly priced or even expensive. Agree? Okay.
Slightly, yeah.
So I need to imagine that 2022, the market went up another 20%. Just imagine that.
Yeah. Portfolio looks good. But
You may feel happy, right? Oh, right. But would you have anything to buy?
Adam, are you now doing NLP? Just a question.
We are always doing NLP.
Are we being brainwashed?
Yeah, you are. You're right. and then let's now think that the next 3 years, the market goes up 20%, 20%, 20%.
Yeah.
And everything is so freaking overpriced. Would that be better for you and me?
Hit DCA, but more expensive.
You get me? Yeah. So I mean, if I were having objective of building my wealth in the next 5 or 10 years, I would rather the market go as low as it can now, or next year, or the year, or the next year, because then I have a great chance of accumulating the shares, so that over the longer run, I'm going to have a bigger return. So there's always a flip side to every equation, And the trouble is, remember, how you feel depends on the language you use. So if you say things that, my portfolio is down, or my portfolio lost money this year, of course you feel bad, right? But why should you feel bad? If you bought, now think about it, right? You have no control over where the market goes in the short term. You got no control, right? And you can't predict what. So why feel bad about something you can't control and you can't predict? The only thing you can control is what you buy. It's the quality of business you buy. The only thing you can control is your research, right? So if you bought great companies and there's nothing wrong with the companies, and the companies are still growing and still dominating the industry, then there's no reason to feel bad.
Adam, on this note, right, can I ask you personally, do you think that human behavior, right, like the herd behavior and including our own behavior, right, is it like more important than the macro indicators and all these things? Of course.
And again, I'm not saying this. This is said by all the greatest investors out there, Buffett, Peter Lynch, Charlie Munger, right? Whether you are a trader or investor, 70% comes down to your psychology. Like Buffett always says, it's not how smart you are. It's your temperament, your ability to manage your emotions and your perspectives that make a difference. Now, Peter Lynch or Buffett or Munger the smartest people in the world? No. I mean, they are smart, but there are many people a lot smarter than them. But there are many people a lot smarter than them that are in jail. There are a lot of people who are smarter than them who are broke, right? Because for some reason, their ego got in the way, or they couldn't manage their emotions, and that's why they screw up. So if you look at the most successful, not just investors, but the most successful investors, traders, entrepreneurs in the long run, yes, they are smart, but they are not the smartest people in the world. Okay. That's why, doesn't mean you have a PhD in finance, you'll be a millionaire. Doesn't mean you've got MBA from Wharton, you'll be a business owner, right? In fact, you may not be a good business person with an MBA, or you may not be a good investor with a PhD. Because what matters most is really your psychology, your emotional management. All right. I mean, that's why I think for me, one of my advantages was in my early days, I started learning NLP to manage my emotional state, to manage my perceptions and all those things. So that is what I think is my greatest edge. My greatest edge is not knowing some special technical analysis indicator or some special DCA, because that one any finance student can tell you, any analyst can tell you, right? But my edge is the emotional management, looking at things from a very different perspective. I'll suggest you guys focus on that and
right.
do that, right? Yeah.
I want to totally agree, by the way, because I'm currently in business school, and some of the professors are pretty questionable. But that's a topic for another day. I think I just wanted to circle back to just talking about individual companies. So Adam has been speaking at length on many of the different companies on your channel, right? You talk about Meta, you talk about Adobe, and you even talk about Tesla. So since Adam is already on the hot seat today, and we have two, at least, personally, I'm not an investor in Tesla, but the other three of them are invested in Tesla. So you guys have any questions for Adam on since he's already here? And
be brutal. Ask me the most brutal questions.
Burning question.
Three guys are in Tesla, is it?
Yeah. Adam,
interesting. By the way, yesterday I got a message from one of my students. The burger made $250,000 shorting Tesla in the last 6 days.
Wow.
Last week. But anyway, go ahead. Yeah.
Okay. Anyway, I wanted to ask you, because I watched both your Tesla videos, part 1 and part 2. So you were plotting on the chart, right? You say that about 110, it will be a 20% discount based on your discounted cash flow.
138 was my valuation, if I'm not wrong.
Yeah, 138, and then you say that 20%, that's about 110. You think that is pretty okay because there's like a 20% buffer. And the strong support is at $88.
Yeah, the super strong long-term support.
Yeah. So it hit like 107 recently. So I'm just curious, did you ever think in your mind to actually buy a little bit?
No,
would Adam buy Tesla?
No,
like $40 you also won't buy, or $30?
No, I'm not interested.
Oh,
it's not my game. No, I'm not saying that it's a lousy business. I'm not saying that. I'm not saying that you shouldn't buy. It's just not my game. It's like, for example, right? My wife to me is the greatest wife in the world. Is the greatest woman I could have ever married. But question, would you marry my wife? Maybe not, right? Because it's not your type. May not be your type, but she's my type. Okay? So Tesla's the kind of stock that is just not my type. I don't care how cheap it goes. I don't care how high it goes. It's just not my type. So I have to marry someone or buy something that I feel comfortable with. That's my type.
Why is it not your type? Yeah.
Why is it not my type? And I shared the reasons in my video, right? So the first reason why is because
CapEx.
Sorry?
CapEx.
Yeah. You see, it's okay. So I tend to avoid companies that have high physical CapEx, that suck up a lot of that have a lot of maintenance CapEx. Now, there are two kinds of CapEx, maintenance and growth CapEx. So maintenance CapEx means a lot of CapEx required to maintain the operations, which you need in manufacturing, in automotive. It's about maintenance CapEx, right? So I tend to like to avoid those kind of companies. It's just my style. I like companies with little or no physical assets or CapEx, right? That's number one. Number two is I feel uncomfortable with Elon Musk. All right, for a few reasons. Number one, like I said, I don't like a business that's very tied to a cult personality, because if that person gets hit by a truck or the guy goes a bit cuckoo, then the whole business is going to be affected. Okay. And you can't deny the fact that recently he's gone a bit cuckoo, right? With his political ranting and all that, which I don't like. Okay, see, to me, the most important thing about investing is certainty. I need to feel very certain and what's going to happen in 10 years or 20. I need to be fair. So if there's any uncertainty, I rather not. So if you ask me, would I rather invest in Tesla versus Hershey's chocolates? I rather take Hershey's chocolates. I rather take McDonald's. Could I make less money? Yes. May I have lower returns? Yes. But I can sleep at night. Okay. So I guess it really depends on your objective, right? So I keep telling people that when it comes to investing, my number one objective is not about making money. My number one objective is not to lose money. That's my number one objective. Then my number two objective is how do I get the highest returns from the set of companies that I know I can't lose money in over the longer term. Sure, in the short term, prices can drop 10, 20, 30% in any business. That's volatility. But you don't lose anything if you don't sell. Right? You ain't losing shit if you don't sell, right? You only sell if you're forced to sell. Either you're in margin or you need the money, right? Which you should never be. That's why you never should buy on margin. You should never buy with money that you urgently need. Then in that case, you're not forced to sell. All right. And if it's a good business, it will always go up over time. So I mean, that's the second reason, right? The third reason is, again, if you study history, you find that any revolutionary industry, whether it's the airline industry, remember that, I mean, in the early 1900s, no one flew, right? Then the first commercial flight, and now everyone flies on a plane. Revolutionary, okay? But if you look at the last 100 years, if you add up the aggregate earnings of all the airlines in the world, guess what's the profit? Add up the aggregate profits of all the airlines in the world.
I don't think they're making money. Yeah.
Negative. Okay. Why? Because the nature of the industry is very unprofitable because of fuel costs, because of labor costs, because of very competitive, because of high maintenance costs, whatever it is, right? Same thing for the automotive industry. If you go back 100 years, the US had 2,000 US car manufacturers in the US, right? And then when bankrupt, in the end left 3, right? Of which GM, Ford, and Chrysler. Chrysler went bankrupt, bought over by Fiat. GM went bankrupt once. Ford is the only one that did not go bankrupt out of all of them. And they're not really making very much money anyway, right? And of course, Tesla began to join in 2018. And of course, in the early years, Tesla will make a lot of money because they pioneered electric vehicles, they pioneered the technology, and they got 70% market share. Of course, if you're the only dog in the street, you do very well. But the question you got asked is 10 years from now, when more and more companies go into EV, will they be able to maintain their dominance? Maybe, maybe not. So the thing is, it is unpredictable. It is uncertain, right? So for me, I just don't like that, because when I invest in something, I don't think this year or next year or 3 years. I think 15, 20 years from now. Okay. Now, having said that, I went long on Tesla yesterday as a trade using options. So that's the difference. But I will not invest. So there's a big difference between investing and trading. Trading, I'll trade anything. I'll trade dog shit also if I think dog shit is going up. Okay. But investing is something different. So it's a separate thing. So you guys know my analogy, right? Investing is marrying and trading is a one-night stand.
I wanted to show you a tweet before it's on the
Sure.
same. Give me a moment. I share, right? I'll share this tweet. Can you see this tweet? Wait.
Yeah.
Can you
If
see
I
this
didn't
tweet?
sell, it's not a loss. Yeah.
Right. He shared it not too long ago.
Okay, so it really depends, You see, how many of you have heard of this statement that don't catch a falling knife?
Yeah,
You guys heard that
plenty.
statement?
Many
Right.
times.
Yeah,
Okay.
many times.
So is that true? Yes.
I think trading
if you
wise,
are a
yes.
trader, if you are a trader, you never catch a falling knife. That's true, right? Because trading, what is your time frame? Your time frame is a few days, a few weeks. So you never catch a falling knife. But as an investor, it doesn't make sense because as an investor, you want to buy as low as possible. It's okay to average down when you see a 90-degree drop. So whether something is right or wrong depends on what's the context of it in. Make sense? All right. So again, that statement that Ken made, right, about what is not a loss if you don't sow. Is it from a trading perspective or an investing perspective? Right? Because in a trading perspective, you have to cut loss. Like for me, in a trade, when I enter, I always enter with a predefined stop loss, which is normally about 7% below my entry point, about 1.5 ATR. And I will cut loss no matter what, because it's a trade. Okay. But if it's an investment, then you want to buy more as it goes low, because it depends on your time frame. It depends on your objective. So we must be very careful to take a statement and then say whether it's right or wrong, because it depends. You know what I'm saying?
What about money-making perspective? Say we don't label trading or investing, just want to make money. So from that perspective, how do you see that?
Yeah. So does trading or investing make more money?
Depends on the person executing, right?
Yeah,
Yeah, depends on the person executing.
Okay, let's say the best trader in the world and the best investor in the world. Right?
I think investor will win, because if you look through the top billionaires,
Right.
or
The
you
answer
don't
is
see
the
traders.
investor will always win over time. Now, people think that in trading, where you get in, get out, you market time and you cut loss, right? You never lose money. Is that true? No. Look at one of the greatest traders in the world. Let's talk about some of them. Number one, Jesse Livermore. You guys heard of Jesse Livermore?
Yeah,
He's known as one of the greatest traders that ever lived, right? So he made $100 million during the Great Depression, which is equivalent to like few billion dollars today, right? He made $1 million in 1906 during the panic of 1906? Can't remember. Okay, so traders can make a lot in a certain period of time because they get the direction right. But after that, Jesse Livermore went bankrupt 3 times because he lost everything. Then he made it back, lost everything, made it back, lost everything. In the end, he committed suicide. He shot himself in the head. Okay. Then let's talk about this guy called, what's the guy's name? The turtle trader guy, the guy who trained the turtle traders to, Richard Dennis, right? One of the greatest traders in the 80s as well. He turned like $2,000 into $200 million. One of the greatest traders. But in the end, what happened? Lost everything. Look at another one, Bill Dunn, one of the top futures traders in the world. Bill Dunn, right? You can go online, you can look at his equity curve for 40 years. He's one of the greatest trend following traders. You talk about market timers. He's known as one of the greatest market timers in 40 years. Okay. Now, even he, during his 40-year run, he beat the S&P, right? But he had periods where he had a 50% drawdowns many times. And his drawdowns lasted like 1.5 years, Okay. So remember that whether you are a trader or investor, you will go through periods of drawdowns, 20, 30, 40% even, and extended periods. That's why I keep saying that every style can make money sometimes. Or rather, every style works in certain periods and doesn't work in other periods. But every style can make money if you stick to that style over the longer run. Okay? Now, again, back to the question, right? So if you look at the greatest traders, let's put in George Soros, okay? Let's put in Bill Dunn. Let's put in Steve Cohen. By the way, Steve Cohen, in the end, I think he got convicted for insider trading or I don't know what, right? These are the greatest traders. What's their net worth? I don't know, 5, 10 billion, 20 billion, right? But look at the greatest investors, like Buffett.
For the trader, what about people like Stanley Druckenmiller? So I think he's like no down year one. So really good at trading.
I don't know. There are definitely down years in Druckenmiller. There are down years. And Druckenmiller is not, okay, these people, some of them are hybrid. They are like sometimes a bit trader, sometimes a bit investor.
I think I wanted to pivot over because you were sharing some of your investing philosophies on how you pick companies and look at companies, right? I think some of the greater names out there that fit your criteria, things like Meta, Adobe, they're asset light, they have strong brand equity, they're the market leader, etc.
Yeah.
But I think one of the recent developments around one of the companies, which is Adobe, I believe you follow the Figma acquisition, right? I think they paid $20 billion.
I did 2 videos on Figma.
Yeah. So on that topic, right, I think there is always pros and cons to a specific criteria, right? So being asset heavy means that it's not easy to just disrupt the person. So it's not easy to disrupt the company like TSMC, for example. You have like all the fabs out there. You have so many manufacturing capabilities and human resource. But on the flip side, people like Meta, China just releases a devil app called TikTok, and then boom, suddenly all the advertising and all the time spent gets sucked away. So I think from that perspective, if you look at a lot of these asset-like companies, are you not worried? Because there is this uncertainty always lurking around. Oh, who is the next person that's going to disrupt me? Then I need to buy them away, or I need to do something about them, and it's always a worry that is at the back of my investing concern. I just wanted to hear your thoughts on those asset-like companies.
So to me, the most important thing in investing in a company is the moat, the economic moat, right? That's number one. So as long as the moat is intact, even if they got short-term headwinds, it doesn't matter, because with the moat, they're able to dominate and they'll be able to generate positive free cash flow in the future. So what gives a company a moat? So there are a few moat sources. The first is a brand, right? So for example, if you look at Nike, what's their main moat? Is the brand. People are willing to pay a lot more just for the Nike brand, because when you wear the Nike shoes, somehow you can jump higher. You wear the Jordan shoes, somehow you can fly, right? It's a very emotional thing, but it's very, very powerful. Coke, the moat is also the brand, right? Apple is also the brand, for example, okay? So it's not about asset light or what are the moat sources, okay? Now, if you look at Nike, is Nike asset light?
Actually, don't know.
I'm not too sure.
Yes, they are asset light because they outsource all their manufacturing. They don't do their manufacturing, right? Is Coke asset light?
Yeah, I think so.
Yes, because they only own the bloody formula. They outsource the bottling, right? Is Apple asset light? Yes, Apple outsource the manufacturing. They only own the patents. So Apple is asset light, Nike is asset light. You get that? So it's not about asset light or not asset light. It's what's the moat. So the first moat source is the brand. Okay. A so-called brand, an enduring brand monopoly. Okay. The second moat source is what we call switching cost. That means once the customer uses it, it's very hard to move away, right? Because they are kind of like stuck there, right? So Apple has high switching costs to an Apple user because you're in the Apple ecosystem. Your Apple Watch sync to your iPhone, sync to your Mac, and if you buy a Samsung, it can't sync. So you're kind of like stuck in that system. It locks you in. Amazon AWS has a very strong switching cost. You guys know, for example, Netflix, the entire Netflix business is built on AWS, right? Disney Plus is built on AWS.
Yeah.
So many great companies like Adobe, if I'm not wrong, is also built on AWS, if I'm not wrong, right? And Netflix has said in their financial statements that if Amazon were to raise their prices, they have no choice but to pay. Right, so Amazon has got them all by the balls in a way, right? And Netflix has said that if they were to migrate out of AWS into Azure or that, it'll take them 3 years to migrate. Can you imagine? Can Netflix be done for 3 years? So that's a very powerful moat source, which is the high switching cost, right? Then the third one is the network effect. Network effect is you want to be there because everyone is there. So Meta is the network effect. Amazon also has a network effect. Then the fourth is economies of scale, like Costco, like Walmart. Okay. Fifth is barriers to entries because of regulations like Lockheed Martin. So these are the 5 main moat sources. So the most important question when you invest in a company is, out of the 5, how many has it got? All right. So let's look at Apple. Apple got brand. Would you buy because of the brand? Yeah, because you won't be caught dead with Xiaomi, for example, right? Does Apple have high switching costs?
Yes.
Yeah. Does Apple have a network effect? A bit, in a sense that if my family all use iPhones, I can FaceTime. So there's a bit of a network effect there. You get my point? So the important thing when you buy a business is you want to make sure out of the 5, you have at least 2 or 3 of the mode sources. If you got all 5, very hard for anyone to disrupt you.
But even if you, let's say you have all 5, would you pay any valuations for it? Like, would margin of safety still be a
No,
consideration?
of course, you still want a margin of safety,
Right.
right?
Okay,
Yeah, you still want a
understand.
margin of safety. Oh, of course. So if you look at Tesla, for example, let's look at Tesla, right? Let's look at a 5. Number 1, does it have a strong brand, enduring brand that people are willing to pay a premium for?
For now,
yes.
yes. For now, yes.
For now, lah.
For now, yes, in the EV space, but isn't he screwing up his own brand, alienating a lot of people because of his politics and all that?
Right.
Yes,
You
yes.
think
Right.
about it, he's really screwing up his first mode source already.
Hmm.
I would argue, now for me, I would argue that I would rather own Ferrari than Tesla in terms of which one has a stronger brand.
One is luxury, one is premium, different.
Yeah, but if you think about it, right, if you look at it, I mean, Ferrari has been around for decades. And 10, 20 years from now, would Ferrari still dominate in the super luxury space? Who is Ferrari
Probably.
competing with? People who buy Ferrari, will they buy a Toyota or Hyundai or a Merc? No, right?
No.
So who are you competing with, Ferrari? Maybe Lambo? Maybe Aston Martin? So, and Ferrari is still that number 1. So to me, I don't know. I mean, personally, if you ask me to choose between Ferrari and Tesla, I'd rather choose Ferrari based on that number 1 mode source, right? Okay, number 2, switching costs. Does Tesla have a switching cost?
Not much.
No.
Don't have lah.
Right. Network effect? No.
A bit.
Economies
The
of scale?
charging infrastructure
Maybe,
can be
yeah,
considered.
okay.
Yeah.
Okay. Economies of scale, right now, yes. Right, because they are the only ones that can build EV cheaper than anyone else. So they have the economies of scale. Barriers to entry in terms of regulations, not really, right?
Come from the scale also, because the other can enter, but they will be loss making.
Correct. So they have 2 mode sources, brand and the scale. They have 2. So the question you got to ask is, how sustainable are these 2, and is it growing or is it eroding?
I have
I
a
don't know lah.
questions.
Right, it's up to.
I have a questions here. Do you see innovations as a mode? Because for those who invested in, like talking about Adobe, talking about Tesla, how much focus are you giving into innovation? I'll just give one more example, because not too long ago, I think Adobe just acquired Figma.
Yeah.
So it seems that Figma is doing something that's interesting and they are not able to do it themselves. That's why they
Correct, which is a collaborative,
So
part. Yeah.
there's another company that is not acquired yet, but there's some speculation, which is Canva, which is the one that people use to do a lot of arts and which is 100% cloud-based. So if Adobe is not able to do that, come up with new stuff themselves, right? What they can do is just buying other competitors, which doesn't look good, right? Because as a tech companies, you should do your own tech innovations, similar to Tesla. Also, they do their own tech, they own their technology or so on. Do you recognize that as a mode? I know in the traditional sense, people don't see that, but I just want to hear your view.
Technology by itself is not a sustainable mode. Technology by itself is not a sustainable mode. All right. So a good example. Now I got to tell you this. In the earlier years, I was very hesitant to buy Apple. Because I felt that Apple didn't have a very strong mode, because it's like, you can make the really cool iPhone touchscreen, but so can everyone else, right? And people can make a better phone than you and all that, right? So you're right, technology is not sustainable. Technology can be disrupted very, very fast. So today, my question is the technology Apple's strongest mode source? I don't think so. I don't think so, right? Because Samsung can come out with a more innovative phone, right? So that is not their mode source. Their mode source is their brand. It's just Apple's cool, right? And the other mode source is the ecosystem they build with the iCloud and all those things. All right. So only when they started to build this ecosystem, then I felt that Apple had a moat. Before they had this ecosystem, when everything was a standalone product, I didn't really dare to invest in Apple at the time. Okay, so technology by itself is not a sustainable moat, but it has to lead to eventually a moat coming from those 5 sources.
Wouldn't it be like everyone is saying that Tesla has that S curve thing, right? But so like wouldn't it make sense to like invest in Tesla now, then when they have all those FSD ready, then you would profit and just sell away?
Okay. Now, remember that when you invest, right, there are many styles of investing. Okay, so when I teach my students, I say there's altogether 7 styles of investing, 7 theses, right? The first is you invest in companies that have secular growth, that have already an established moat and all those things. Then second are companies that have low growth, but very defensive, very predictable, like your McDonald's, your Thermo Fisher, your United Health. Okay. Then the third one are what we call speculative growth. Speculative growth means to say they may not have a very strong moat yet, but they are growing very, very fast. And it's the S-curve thing. So the S-curve thing you're talking about would be under the third category, which is what we call the speculative growth category. Then the fourth category are what we call deep cyclicals. Deep cyclicals are like banks, shipping, oil and gas. So deep cyclicals are companies where they make a lot, then they lose a lot. They follow the big economic cycle. So those type, you only buy them near the bottom of the cycle during recessions, and then you sell them once they recover. That's what we call the deep cyclical play. Then the fifth one is deep value play, which is the Ben Graham style. So deep value play are companies that may not be very good, may not have a moat, but damn cheap, like selling below cash or whatever. We call it asset plays, right?
Net stuff.
Net stuff,
Yeah.
right? Then wait, did I miss out something? All right. Sixth one is dividend play, buying things because they have good yield, like REITs or whatever it is. So nothing wrong. That's why when I tell my students, when you buy something, ask yourself, which category does it fall in? Which thesis does it fall in? All right. And yes, there's nothing wrong with buying speculative S-curve stocks, but you don't want it to make up too much of your portfolio. It has to be a certain allocation. You follow what I'm saying? Yeah. So to me, it's all about allocation. Like if you think that there's a strong S-curve stock, what is it, Palantir or Tesla, things like that, then, put in maybe 5% of your portfolio or 10%, whatever it may be. But, I wouldn't put in 50%. Right. So to me, it's all about allocation.
Adam, I have one last question. I know that we are running out of time. I have one last question. This question is not from me. It's from my wife.
Yeah.
She listens to you also. She just want me to ask you, what is the one stock, right, that for like very risk-averse people, like those auntie, right, don't want to lose too much, don't want to be too speculative. What's the one stock that, in your view, is quite stable, okay for them over the long term?
Just one.
Just maybe if you can give 3, I think she'll be over the moon now. But I mean, if
okay, so first of all, I'll never suggest you put all your money into one stock, lah.
No, not
Okay.
all, not all. Just
so I would always say that you should have at least minimum 8 to 10, minimum 8 to 10. Okay, and so let's say we take 10, right? And out of the 10, diversify between healthcare, financials, consumer discretionary, technology, and staples, consumer staples. These 5. I know there's other sectors, but these are my 5 favorite sectors, right? And out of the 5, choose the strongest 2. So example, healthcare. Maybe we can have a discussion here, right? So what do you guys think? Healthcare, what do you think are the strongest 2 healthcare companies that have the widest moats?
P&G? I really don't know
P&G
healthcare.
is not healthcare. P&G is
Pfizer?
under staples.
Or Pfizer.
Okay,
I don't
Pfizer.
know.
Yeah. Come on, let's throw ideas.
United Health?
United Health, yeah.
I think I only know those two companies.
Does
Off
Johnson
the
and
top of my
Johnson
head.
considered healthcare?
Sorry, which one?
Johnson and Johnson.
Yeah, healthcare. J&J is healthcare. Yeah, right. So, I mean, personally, for me, my favorites would be Thermo Fisher and United Health. J&J is not bad, but J&J, the growth is a lot lower. Whereas Thermo Fisher and United Health, they still have pretty strong top-line growth. I tend to avoid pure pharmaceutical companies like Pfizer or Merck and all that, because pure pharma, very unpredictable, because once their pipeline of drugs expire, they have to keep having new patents to replace the pipeline. If they can't, they'll be in trouble. So pure pharma goes through periods where you can have big drawdowns. So I tend to avoid pure pharma. Okay. Now, number two, financials. So what do you guys think? Two strongest financial companies.
JP Morgan, BlackRock.
Visa, Master. All
Okay,
your
so
big
Visa,
banks.
Master, JP Morgan, BlackRock. Okay. Yeah, they're pretty good. One of my personal favorites is S&P Global.
Oh yeah.
Which is-
the credit
You said before.
rating.
Yeah, it's a credit rating agency. So it's very similar to Moody's. So either Moody's or SPGI, or you could own the exchanges like Intercontinental Exchange, ICE, that owns New York Stock Exchange. They also own a lot of the top futures exchange. So why I prefer these companies versus the banks is banks are a lot more cyclical, and banks are highly leveraged, more highly leveraged. So if there's a financial crisis and all that, they are more vulnerable, right? I also like Visa and MasterCard a lot. You know, a lot of people have the misconception that Visa and MasterCard are credit card companies. They are not credit card companies. American Express is a credit card company.
Oh.
Visa, MasterCard are not credit card companies. Why? You know what's the difference, right?
Yeah,
American
the railway.
Express themselves issue the card. If you don't pay the money, who get the bad debt? American Express. Okay, they take the risk. They take the credit risk. Visa, MasterCard has zero credit risk. It's the banks that issue the card, not them. In fact, the banks have to pay them a royalty to put the Visa logo there.
Wow.
Okay, so they purely collect royalties. And Visa, MasterCard are payment gateways. They are payment infrastructure that allow the transactions. So whether you use GrabPay or Apple Pay or Square, now they call it Block, whatever, they all go through Visa or MasterCard payment gateway. So that is a toll booth business with no credit risk, you know, and very high growth, right? So those are my favorite financial companies. Okay, then next one would be consumer discretionary. So consumer discretionary would be your Nike, your Amazon, your booking.com and things like that, you know. So to me, my favorite is still Amazon in terms of the discretionary space, Amazon. Okay. Then staples, consumer staples.
Oh, just now
What do you think the strongest ones, huh?
Yeah,
You mentioned
Costco.
P&G,
Costco.
Costco,
Walmart.
Walmart,
Coca-Cola.
yeah, Coke, right? Estee Lauder.
Hmm.
Interestingly, at first I thought Estee Lauder was a discretionary company, consumer discretionary, but actually it's classified under consumer staples. Interesting.
What?
Yeah, it's actually classified under consumer staples because I guess they feel that to women it's an essential item.
There's this theory, right, called the lipstick effect. So even in a recessionary period, they still look good. So that's
They
why
still
it's a
look good.
staple.
Yeah.
Yeah.
So yeah, Estee Lauder is one of my favorite staple companies because most staple companies like Pepsi, P&G, and Coke, their growth rates are very low, like single-digit growth rates. But Estee Lauder is one of those rare staples that still has a pretty good growth rate. My favorite sector of all is actually healthcare, out of all, because healthcare has the perfect combination of defensiveness and growth.
Okay.
Right. Yeah,
Okay.
and of course, in the technology space, I think to me the strongest is Microsoft.
Then how come you're recommending individual stocks and not like the S&P 500 ETF? Because like there would be a more balanced approach.
Okay, so remember when you buy the S&P 500, you're buying the 500 largest companies in America, right? So if you look at these 500 companies, are they all great companies? Are they all profitable? No, right? So within the 500, you got the good, the bad, the ugly, and the beautiful out of the 500. So if you have the fundamental skills, you have the fundamental analysis background, out of the 500 to pick the ones that have the highest returns on capital, the strongest moats, then of course you're going to beat the S&P, right? Over the longer run.
There are also other ETFs like the S&P 500 top 50 stocks and also that QQQ thing. Like, wouldn't that give a higher return also?
The top 50, but again, you don't know what's their criteria? How do they rate it as top 50? Because everyone has their own ingredients, right?
Okay.
Yeah. Of course, I mean, for the majority of people who have not taken an investing course, they don't have the skills to analyze the moat and all that. Yeah, just buy the S&P and close your eyes. But I mean, if you guys have taken the effort to learn these skills, then use it.
Yeah,
all right.
makes sense.
It's like, like in the old days, before Apple Music, we had to buy the album, right? The CD album, and they got 20 songs, but out of the 20, there's only 3 good singles. So if you know what are the nice singles, why don't you just buy the singles instead of just buying the whole album?
Right. Thanks. I think this kind of wraps up the entire discussion for today. So we hope that you enjoyed the entire
Yeah, it was
podcast
fun.
itself.
It was fun discussing.
Yeah. And I think Adam actually did drop a lot of whether is it from theory to even giving examples, and also we had a very interesting discussion with this whole idea of DCA versus trying to time the market as well. So yeah, as always, remember to help smash that like button so that the YouTube gods will bless our channel and we can invite more and more guests to gain so many insightful comments and ideas about investing in the stock market again. So once again, thanks Adam for coming onto the channel, and I think we all greatly appreciate it, and I think the audience will appreciate it as well. Yeah, thanks.
No
okay,
worries. Nice
thanks.
meeting you guys.
Yes.
Thanks,
okay.
Adam.
Thank you.
We'll see you in the next video. Goodbye.
Bye.